So what is really going on with the bank failures? That is the subject of this video. Welcome to the Financial Fast Lane. My name is Lane Martinson. So to better understand what is causing the recent bank failures, I think it's important to understand a few fundamental economic principles. I'm going to explain 7 basic concepts that I think everyone should know. First has to do with banks. Fractional banking is a banking system in which banks hold only a fraction of the deposits of their customers in reserve, while lending out the rest to earn interest. So, for example, if a bank has $100 in deposits, it might be required to hold 10% in reserves, or $10, and then it can lend out the remaining $90. Fractional banking can stimulate economic growth, but it comes with inherent risks, such as liquidity risk and a run on the bank. So if everybody wants their money all at once, and they all go to the bank to withdraw, the bank does not have enough money. And so it creates panic, and it creates bank failures. So number 2 is the FDIC, the Federal Deposit Insurance Corporation. So to provide consumer confidence, the federal government insures up to $250,000 per depositor per bank. It's essentially insurance that your money will be safe even if the bank fails. Up to that amount. Anything over and above that amount is not insured and would be at risk at a bank. Third is the basic understanding of bonds. So bonds are debt instruments. It's a type of a loan. So when debt is securitized, it can be bought and sold as an investment. So when you buy or sell a bond, you are buying and selling a loan. So bonds are issued by governments, by corporations, by individuals. For example, if you were to get a mortgage, you have a 30-year loan. Well, that loan can be bought and sold by other financial institutions or individuals who want to earn the interest on your mortgage. But there's some risks associated with buying long-term bonds, right? The fourth concept has to do with inflation and an inverted yield curve. So an inverted yield curve is a term used to describe an unusual situation in the bond market where short-term interest rates are higher than long-term interest rates. Normally, long-term bonds pay higher interest rates to compensate investors for taking the risk of holding bonds over a longer period of time. An inverted yield curve is typically considered an indication of a coming recession. Number 5 has to do with interest rates and bond values. So when interest rates go up, the value of bonds goes down. There is an inverse relationship between interest rates and bonds. A rising interest rate environment puts stress on bondholders. And when you have a bank holding low interest bonds with the need for more liquidity, they are forced to sell, taking huge losses. So understanding some of these basic concepts, we can then identify the source of the problem. So the federal government has been fiscally irresponsible and monetarily irresponsible for many years. Deficit spending is spending money that you don't have, or which the government doesn't have, which adds to our massive national debt. The printing of money and the unprecedented massive stimulus of trillions of dollars over the past few years is the direct cause of the inflation that we are experiencing now. Inflation hurts everyone, and it will ultimately lead to higher taxes. Number 7, where can you keep your money safe? There are always risks, no matter what you do in this life. Getting out of bed in the morning comes with a variety of risks. But never getting out of bed also comes with risks and problems, right? Now, burying your money in the backyard or putting it under your mattress is a way to guarantee that the value will decrease over time. And so we need our money to grow, but we want it to grow without unnecessary risk, right? Or without too much risk. There is wisdom in diversification. And I'm not just talking about stocks and bonds or traditional asset allocation, I'm talking about multiple asset classes, which might include equities, real estate, commodities, certain insurance products that provide certain guarantees. Investment advice can never be given to a general audience. It will always be uniquely different for each person, depending upon your needs, your risk tolerance, your goals, your situation. So I hope you found value in this video. If you did, please consider subscribing or giving us a thumbs up. And I look forward to seeing you in the next episode of the Financial Fast Lane.